next learning objective is to calculate the employer taxes for payroll. So the employer taxes include OSTI and Medicare, just like the employees pay, FUTA, which is federal unemployment, SUTA, which is state unemployment, and then workers' compensation, also called workers' comp. The employer payroll taxes include Social Security, OSTI, and high, Medicare. So the employer will match the employee contribution. So if an employee puts in $80 into OSTI, then the employer also has to pay $80 into OSTI. Same with Medicare. So for OSTI, both employer and the employee pay 6.2% of the employee's taxable gross wages. And with Medicare, both the employer and the employee pay 1.45% of employee gross wages. So now you might be thinking to yourself, well, what if I am unemployed? What if I am self-employed? Well, if you are self-employed, that means you are both the employer and the employee. So for OSTI, someone who is self-employed will pay double 6.2%. In other words, 12.4%. Same thing with Medicare. The employer also pays unemployment taxes. These taxes help provide unemployed workers with unemployment benefits. So let's talk about the unemployment. First, we have FUTA taxes. FUTA stands for Federal Unemployment Tax Act. So this is an act, a law, that requires employers to pay into the FUTA to help run the unemployment program. So the FUTA tax pays the administration costs of the unemployment program. It does not pay the benefits. So when an employer pays a FUTA tax, that money is used just to run the unemployment plan. It is not used, or those contributions are not used to pay the benefits of the workers. Next is SUTA taxes. SUTA stands for the State Unemployment Tax Act. So this is a law that requires employers to pay into the state unemployment tax plan. Now this tax, which is much higher than FUTA, goes to pay the unemployment benefits. So if a worker is unemployed, and let's say they get $500 a week for unemployment benefits, that $500 comes from the SUTA plan. So the SUTA taxes go to pay the unemployment benefits to the people who are unemployed, and the FUTA taxes go to pay for running the unemployment department. Now, payroll software such as Quicken often refers to SUTA tax as SUI, which stands for State Unemployment Insurance. So if you see SUTA, it means the same as SUI. So what is the actual tax for FUTA? This is a little bit complicated at first. So the FUTA tax is 6.2% on wages earned by each employee up to the wage base limit. But this wage base is only $7,000. So in other words, now remember, this is an employer tax, not an employee tax. But it is based on how much each employee pays. So if an employee makes $40,000 a year, the employer only has to pay FUTA taxes on the first $7,000 of each calendar year for that employee. Now there is a credit, and it is a huge credit, that employers will get if they pay their state unemployment, in other words, SUTA, on time. So if an employer pays their SUTA taxes on time, then they get a credit of 5.4% on the FUTA tax. This is a huge incentive to make sure that you pay your SUTA tax on time. So because most employers pay their SUTA on time, that means they're going to get the 5.4% credit. So the net FUTA tax is 0.8%. With that, or how we calculated that is you take the 6.2%, you subtract the credit of 5.4% for paying SUTA on time, and that gives us a net FUTA tax rate of only 0.8%. It's not a very big tax at all. And remember, it's also only taxed on the first $7,000 of each employee's gross pay per year. Now, how about SUTA taxes? Now, each state is going to determine the wage base limit, and our homework is going to assume that it's $7,000, same as the FUTA. But what type of percentage does each company pay? Well, that depends on the company. A company with a history of laying off a lot of employees will pay a higher SUTA tax rate than a company who does not lay off many people. Why? The company who's laying off a lot of people, their employees are using more unemployment benefits. Therefore, their percentage that they have to pay into the program is going to be higher. So when we get to the homework, it's just going to give you the percentage that that particular company is paying for SUTA. Another payroll tax that employers have to pay is called workers' comp. Workers' compensation is almost never called workers' compensation. Everyone calls it workers' comp, much easier to say. What this does is it insures employees who are injured or killed while on the job. So if you're operating a forklift and you fall off and hurt your head, as long as you were doing it on the job, then workers' compensation insurance might cover that. Now, in most states, this is paid just by the employer. Now, each state is different, so we're not going to go through all the different variations of each state. Now, the way this tax is usually calculated is it's estimated ahead of time at the beginning of the year, and it's calculated for $100 or per $100 of weekly payroll. This will make more sense when we get into the homework problem on this. But just remember that workers' comp, you have to estimate how much you're going to pay your employees at the beginning of the year, and then you're going to pay that into workers' comp at the beginning of the year. So now this is a really important slide. It's a summary slide. So you need to know which payroll taxes the employee pays, which is on the left, and which payroll taxes the employer pays, which is on the right. So the employees on the left, they pay OSTI, Medicare, FIT, and SIT. And the employer is going to also pay OSTI, Medicare, so they will match the amount that the employee pays. But they also have to pay FUTA, SUTA, sometimes called SUI, state unemployment insurance, and workers' comp.